Greetings, it's time for our monthly report on quantitative easing and technological deflation. If you've gotten to the point of watching these videos, you are so far ahead of the curve relative to what most people think and relative to what the financial media and the mainstream media is communicating. Because just by virtue of having found this video, you are so far ahead in terms of your understanding of the relationship between quantitative easing and technological deflation and why trillions of dollars of QE has not caused aberrantly high inflation, that you should congratulate yourself just for having gotten to the point of wanting to learn about these subjects. So we go to our normal Yardeni monthly balance sheet report, November 16th, 2021. This is, of course, in the description box below. Now, these are the four central banks of the world, with the US Federal Reserve being red. As you can see, the US is not even the biggest money printer. The European Union is. Even though Europeans were the ones more afraid of hyperinflation because of what happened a century ago, they are printing more than the United States. These four central banks combined comprise about 90% of the world's quantitative easing being done. Not all of it, but 90%. But as you can see, the United States is only about 1/4 of the entire world's quantitative easing that's being done. The United States has done 8.5 trillion to date, while others have done similar amounts, and Europe has done more, as you can see. But even Japan and China have done amounts approaching what the US has done. So the notion that the US Federal Reserve is printing so much money that it will cause A, inflation, and even worse, B, a prediction that gold will rise in price, is crazy, as I speak about every month. There are no borders to quantitative easing, and there are no borders to technological deflation, and a commodity like gold is priced internationally. So the money printing of one country, which is only 1/4 of all the world's money printing, the notion that it would make gold go up is just very short-sighted. Anyone who says that, like Peter Schiff, is effectively presuming that the United States is the only country in the world. Now, obviously, Peter Schiff knows that there are many countries in the world, and his firm itself is called Euro-Pacific Capital. But when he said the Federal Reserve's printing is going to make gold go up, he's suddenly forgotten that gold is priced internationally, whereas the US is just one country that is not even the biggest contributor to money printing. Since money printing is borderless, only the grand total matters, and since technology is exponential and the deflation resultant from technological progress is exponential, then quantitative easing also has to grow exponentially. So we go to the next chart. Notice this smooth parabolic curve. Those four central banks above combined have done 30.8 trillion. It was flat in 2018 and 19 because they still haven't gotten out of their heads that they're never going to reverse quantitative easing. And whether COVID happened or not, there would have been a shock event that forced them to do more and revert them back to this trend line. Anyone who follows exponential trends or accelerating future study will recognize a parabolic curve here. And I have long said for years and years and years that this curve has to rise at 16 to 24% a year just to offset technological deflation. And that is kind of the rate it's rising at. And that has been true for 11 years. The recent quantitative easing, the notion that it can create aberrant inflation, well, it hasn't created it for 11 years. Why would it create it now? And I have a lot of videos about that subject, as well as we're going to talk about inflation later in this video. But what is the compound annual growth rate? So we take the same data to the chart below. It's already moderated down to 13%. Now, longtime viewers know that I say that the growth rate has to be in a band of 16 to 24% as an optimal cruising speed. That's when it is offsetting technological deflation while not getting high enough to actually cause temporary inflation. The peak of 46% was in February, and that is when there was some chance of aberrant inflation. And take a delay effect because velocity of money hasn't caught up, or the government might be mismanaging certain things in terms of oil supply and so forth. But all those are temporary factors. We're now down to 13%. This is below the optimal band and also very much in line with the growth rates of the prior 11 plus years. In fact, quantitative easing is not enough, as I often say. That's why the market often corrects and they end up having to do more, but they only do the bare minimum. The good thing about the COVID-19 crisis is that it forced the central banks of the world to probe the ceiling and to see whether that would cause inflation, and it really hasn't. But now we're down to 13% year-over-year growth. So even if they're going to attribute anything to the amount of monetary creation done because of the COVID-19 crisis, how long are they going to use that excuse? The peak was in February. This is now October data. The only chance of this amount still causing inflation is if there's a sudden velocity of money spike, or some extreme amount of government mismanagement across many countries, not just across the US, but across many countries, and the chance of at least the former of those two diminishes over time. You can't have this amount of money have a spike of inflation because of increased velocity of money after too much time passes. There is a half-life type of concept to that. Velocity of money has to rise soon if it's going to cause inflation at all. But we're down to 13%. So now we're not even in the zone of aberrantly high quantitative easing anymore. And I repeat yet again, only the worldwide total matters because these things are borderless. The US Federal Reserve is only a 1/4 contributor. It printed 8.5 trillion out of the 30.8 trillion, or about a fourth. And what's even sillier about how people blame the US Federal Reserve as a contributor to inflation, this is what each central bank has done in proportion to the size of its economy. I mentioned earlier how the Eurozone has done more than the Federal Reserve in terms of absolute dollars. But since the Eurozone has a smaller economy than the United States, in proportion to its economy, the Eurozone is about twice as much as the Federal Reserve. The US Federal Reserve, many years combined, has only done about 30% of 1 year's GDP in quantitative easing. And remember, GDP is an annual metric, whereas these lines are the cumulative amount of all of these years. Europe is already at 60% plus. So Europe has done twice as much monetary creation as the United States in proportion to the size of its economy. But even Europe is dwarfed by Japan, which has done more than twice as much as that still. Japan has printed 130% of its annual GDP. That is a gigantic number. If the United States had printed 4 times as much money as it did, it would not still be at the same percentage as Japan. Now, Japan has a smaller economy, and as I just said, these are all worldwide numbers. But anyone who says the US Federal Reserve is going to cause inflation in the US, and even worse, the price of worldwide commodities like gold and oil to rise, really doesn't know what is going on, and the way you can expose them for not knowing what's going on is how they can't explain what's happening in Japan. Japan has printed more than 4 times as much money as the United States in relation to the size of Japan's economy, and nobody claims Japan has high inflation. They are still teetering on the edge of deflation. Why are they teetering on the edge of deflation despite all this printing? Because the printing is borderless. All of Japan's printing goes into the US and to China and to other parts of the world, and therefore they can print so much money and it still does not cause domestic inflation. These facts are so evident, it's just that people can't learn these facts because they think people with economics degrees actually know what's going on, and as we know, nothing could be further from the truth. So these last few images are extremely informative in terms of what is happening regarding world QE, how much is being done by which central bank, and why the worries in the United States are so incredibly misplaced, and the people who keep making wrong predictions are never held to account except on this channel and a few other less well-known sources, because their predictions are wrong not on 1 or 2 levels, but on multiple levels, as I've described. It's really quite insane, but this Japan point is an important one, because if someone can't explain why all this quantitative easing in Japan has not caused inflation, yet they still think that the US is going to be vulnerable to high inflation, they just don't know what's going on. And the fancier their economics degree, the more likely they are to be ignorant about this subject. Because, as we say, there's no other field in the world where the credentialed establishment has less knowledge about what's really going on in their field. And that always means we are on the brink of a major historical turning point in not only that particular field, but in the entire history of the world because of the importance of economics to everything else that we do. So how much inflation do we actually have? Well, as longtime viewers know, I have created thresholds of what should be considered aberrantly high inflation and how to check whether we are getting close to those. So for that, we go to part 2 of this video. Now, as you recall, a few weeks ago, I created a brief table about what threshold I consider to be inflation that is trending higher than optimal. And the threshold is if the US CPI 10-year average compounded growth rate, moving average, is above 3%, and at the same time, if the Goldman Sachs Commodity Index 10-year compound annual growth rate is also above 3%. The two have to be above 3% at the same time. If only one is above 3%, even that doesn't count because that still represents just pockets of inflation. The Goldman Sachs Commodity Index is the more comprehensive of the two metrics because it is not only worldwide, but it also takes into account prices of commodities as they actually trade. So it's not something that can be rigged in any way. A lot of people say the US CPI is rigged. That's not actually true. And if they really think it's rigged, they can look at the Goldman Sachs Commodity Index. The US CPI is the inflation rate of just one country, the United States. It's the largest economy in the world, but it is the inflation rate of just one country. The reason we add it at all is because all this hyperinflation false narrative is originating from the US, and everyone who thinks there is hyperinflation in the US has a very US-centric worldview because quantitative easing is worldwide as technological deflation. But the problem with the CPI in addition is that it not only takes into account commodity prices, but also service prices. And while service prices are a function of inflation, it is harder to say that is always the bad type of inflation because that also comprises wage increases. So service price increases have to be indexed against productivity gains in the service sector, and only if prices are increasing while productivity gains in the service sector are low can you say that that is a negative type of inflation. Because if productivity gains are high, even while prices are increasing, then wages are rising faster than the costs of the services. So that's not always a bad thing. Whereas commodity price increases are always inflation because labor is a much, much smaller component of commodity prices. So where are we, in fact, today, November 9th, 2021? So as always, we go to the Bureau of Labor Statistics website, and we go to the Consumer Price Index. So over here in the Bureau of Labor Statistics, we go to formatting options, and I've chosen original data, 1 month, 3 month, and 12 month. Okay? This is the original data, and it's rising as you would expect under the normal cruising speed of desirable inflation, which in my opinion is 3% a year. 2 to 3% is normal. We'll come back to this to calculate the actual annual compounded growth rate. Now the 1 month data is very noisy, as you can see. It's kind of up here, but this is what grabs the headlines. You can see on a 3 month basis, the peak is already behind us. And while it is choppy over here, it's not rising much anymore. So whatever little blip got all this media hype going, it's already in the past. And the 12 month level, yep, it's currently high, but it's also just offsetting this low period that was there because of the COVID-19 situation. So the only thing that matters is the average. Now, what is the average annual growth rate of the last 10 years? Looks to be about 2%, but we will calculate it exactly like we do every month. So we go up to this topmost data, and with the calculator, we take a 10-year moving average, which is this number, 276.7, and this number, 227, from 10 years ago, and take the annual growth rate, which is the 1/10th root of this. So 277 divided by 227 equals 1.22, so 22% inflation over 10 years, and you take the 1/10th root of that, 1.02, and you minus 1 and multiply by 100 to get the easier representation of percentage. 2%, 2.01%, but the average annual growth rate of inflation over the last 10 years is 2% for the US CPI. That is optimal. That is not high inflation, and it's certainly not hyperinflation. It is 2%, and the recent uptick is in fact bringing inflation to a better level. It was below 2% until now. So this is a favorable development, mind you. This is creating more inflation that technological disruption can consume, and it is a fuel of technological progress. If it got too high, yes, it would be a problem, but at the beginning of the video, I pointed out at what level I would consider this number to be too high, and it's nowhere close to that yet. So now we go to the second metric, which is the Goldman Sachs Commodity Index. Goldman Sachs Commodity Index, 1 year, it's risen 57%. That's huge, right? But remember, we care about the 10-year mark. What is the 10-year growth rate? Minus 1.3%. Minus 1.3%. It has been in deflation for 10 years. People are screaming how oil prices might be $81 a barrel now, but 10 years ago it was $110 a barrel. That is deflation. Minus 1.3%. This is why gold is not rising. This is why oil is so much lower than it was 10 years ago. Minus 1.3%. So that is deflation. So we go back to our table over here and see if we are close to this threshold. Is the 10-year growth rate of the US CPI 3% a year? And is the 10-year growth rate of the Goldman Sachs Commodity Index 3% a year? And as we just saw, the CPI is at 2%. 2.0%, and the Goldman Sachs Commodity Index is at minus 1.3%, so a far distance from 4%. Until both of these are above 3%, I won't say that inflation is starting to edge high, and only then would we say that the amount of quantitative easing has to be tapered or even paused slightly. The fact that the Federal Reserve is already talking about tapering its quantitative easing is a terrible idea. It is something that I discuss in this video up here on the right-hand side. but they are doing this proactively under a fear of high inflation that has just not manifested. And the last 5 times they did this, they caused a market correction and they were forced to print more money than ever before because they just don't understand that technological deflation is exponential, therefore quantitative easing has to be exponential. And the US is just one country that does about 1/4 of the world's money printing. The other 3/4 is not done by the US. And I urge everyone to consider these metrics when believing whether there is high inflation or not. Don't listen to the media. The media is designed to scare you, and when things moderate, the media is nowhere to be found. I guarantee that by March, April, or May, a lot of the headlines about inflation will be greatly muted because the data will have moderated back down, and these numbers will still be nowhere close to 3% at all. That is a certainty. So this is how to parse the actual data versus being swayed by all the media scare tactics and all the people who like to talk about inflation because they want to pretend they know about a complicated subject when they don't. But if you found your way to this channel, then you are certainly more informed than most people who opine about these subjects. And if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.